Well, more on our top story. In the face of considerable uncertainty from the COVID pandemic, Singapore Central Bank is urging households, local companies and the financial sector to stay vigilant and prudent. For more insights on what companies and individuals should look out for in an uncertain economic climate, we're joined by Aurobindo Ghosh. He is the Assistant Professor of Finance at Singapore Management University. He is also the Director of the Citi-SMU FinLit Program. Professor Ghosh, household vulnerability is up slightly compared to pre-pandemic levels, driven mainly by new housing loans. What sort of prudence should individuals or households be exercising?
Thank you so much for the question, Liz. It's important to know that households have to actually take care of their balance sheet, which is the most important part of what they should be taking care of, very much like any other companies. So they should take significant amount of prudence in figuring out how much loan actually to take up. And whatever amount of loan they take up, they have to service it over a period of time. So that is the main concern that the central bank in their financial stability report has also expressed, that having potentially higher debt burden might really jeopardize the resilience of the households going forward.
Well, how do we, exactly could we tell if a household is vulnerable with a high debt burden?
Well, if you look at it, there are already macroprudential policies that are put in place by the central bank, particularly for issuing loans and approving loans by the financial institutions. And they look at something called a total debt service ratio. So total debt service ratio is something that households can look at, which is essentially the amount of debt burden that they have, how much they have to pay compared to their household monthly income. And that is something that is one way of looking at. If that number is too high, then that means that, of course, the debt burden is probably unsustainable. And this is what the central bank has put in place. But households should also be paying attention to the total amount of money that they are spending in servicing their debt going forward. So there are macroprudential policies put in place by the central bank already, but households should also be cognizant of these numbers and not take up debt which could be potentially be unsustainable in future.
Well, Prof, the MAS has warned that individuals' ability to repay their debt could go down as interest rates rise. How serious would the impact be on households?
Well, if you look at it, the current accommodative monetary policy that was instated, particularly throughout globally, because of the impact of the pandemic and what could potentially be the impact on the financial markets. So, because of that, globally there was a coordinated effort to try to reduce the burden on businesses. Particularly, they have to actually meet their obligations as well. Households also were impacted that way. But at the end of the day, the main thing that the households actually need to look at is that potentially this is a temporary measure. This is a measure that is transitory, particularly once we get over the COVID crisis or plan to live with it as an endemic. There will be some levels of normalization by the central bank, as has been indicated as well. So with that normalization, there will potentially be a higher interest rate environment out there. And so if there's a higher level of debt that is there, that is actually a higher level of risk to pay it off. Given the current uncertain condition, as you rightly mentioned in the beginning, there are potential of health crises or health emergencies that can take place, or potential loss of jobs as well, where the individual households have to take care of these exigencies which might come. So taking in too much debt definitely in this environment is not the best thing to do.
And Prof, on building up financial buffers, are you able to give us some examples of how households and even companies can do so?
So, as in my role as the director of the program for Citi Foundation SMU Financial Literacy Program, I actually advise young adults on very similar things, that you have to find out first to look at your needs and wants, then look at opportunity cost, and then go into a habit of saving, then buying insurance and investment prudently. So those are the things that we tell students. So in some sense, we are advising them to be their own CFOs of their own organization, in this case, their household. So CFOs also look at the same set of problems. So they have to look at whether they want to take up a project, or how do you finance that project, and how to go about their day-to-day operations and their financial activities as well. So if you think of it that way, the most important part that companies have to actually deal with in this particular case is to figure out what if scenarios. So they have to look at more like a scenario planning. At the same time, they have to see that what if there is an emergency? Is there an emergency fund that is set aside? So something like a sinking fund, so to say, that is set aside, which will help them kind of go over this sort of bump in the road, so to say. Now, that is one option. The other thing that they can do, of course, to have a regular savings plan, which would give them options of passive income that could give them some levels of assets along the way as well. And that could help them also bridge the difficult conditions or difficult positions that they might be in. So companies go through similar activities as well. They also do something which is important, and MAS also mentioned that in their report, is that they saw that households are not taking up too much short-term debt, like credit card debt. So definitely they are higher interest rate because they are non-collateralized oftentimes. Because of that, households should be paying off their higher interest debt as much as possible and try to keep the longer duration debt that will help them to go over possible scenarios and possible exigencies or emergencies that can come in.
Well, thanks for that. Aurobindo Ghosh, he is Assistant Professor of Finance at SMU.